Welcome in. This is Chit Chat Money, and this is the Thursday deep dive with Ian Gray. Ian is joining us today. How are you doing out? And can I say where you're at?
Go.
Flagstaff.
Yep.
How's
Flagstaff.
the snow out in Flagstaff? Well, weather.
Well, it's almost all melted at this point. We had like 3 feet 2 weeks ago, and there's just some little remnants on the ground now. So it's kind of crazy.
Dan can't.
It even snowed near us recently.
Yeah, it's supposed to snow in Seattle.
Really?
I think like tomorrow. So could have a winter wonderland out here in the Pacific Northwest. It'd be great. But let's get on with the show. We're talking Mohawk Group, small cap name. Ian, you own it in your portfolio. We don't own it at Arch Capital, but
Seven Invest. We got to throw that in there.
We're going to talk about that. Yeah. So before we get that, we're going to talk about Seven Investing. They're our partners, and if you use the promo code CCM at checkout, you get $10 off your first month. And Seven Investing gives you 7 stock recommendations for the long term each month. So it's a great deal. Normally it's $17 a month. You can get $7 for your first one. We love the team over there. They have an eclectic mix of different types of stocks for higher risk names, for lower growth names, dividend plays, stuff like that. And their performance has been outstanding. So the team over there is great.
You're monologuing the sales pitch here.
Yeah.
So you got to pass it off. But
go ahead. Yeah.
It is a lot of fun. I look forward to their picks every month, and they absolutely have killed the market. So you get your money back, I guess.
Perfect for an individual investor that wants to invest in common stocks. But now, Ryan, let's talk about Mohawk Group.
Yeah, so they're a mini conglomerate, really. So when you first look at them, I think Ian and I both had the same impression initially, which was it's just like a consumer goods company that's selling across Amazon and Shopify and stuff like that. And it seemed really boring. But if you dig deeper, it's actually pretty cool. So they have what they call their AI, and it's called Amy, which is artificial intelligence Mohawk e-commerce engine. Am I getting that right?
Yep, that's right.
Okay. And so, but this AI basically helps to optimize e-commerce strategies. So what it's doing is it's going through Amazon and say we're looking up candles, like vanilla scented candles, and some of the ratings are poor, but there's a lot of demand for that product. It goes in, it finds opportunities like that, and it says, this is the product that we should go for. Basically, it finds opportunities, and then Mohawk Group as a company will either develop a product or they'll acquire a company that fits that mold, and they will they'll just pump money into marketing till that becomes the best product on Amazon. So whether it's like promotional or marketing elsewhere, and once it gets good enough ratings, then they can pull back the marketing spend on it, and it's basically at cruise, and it takes way less costs, and they can still generate the same amount of sales. So that's sort of their model. It's all built on this Amy software, but it also includes sort of logistical back-end stuff. So fulfillment centers, finding the quickest way to ship. Some products are really, really good, but they ship weird, so they can exploit opportunities like that. But the consumer goods brands that they have are kitchenware, dehumidifiers, that kind of thing. So it's not super sexy items. It's just stuff that the CEO actually talked about this. So 75% of searches on Amazon don't have a brand name in them. It's like dehumidifiers or ice makers, and they don't put a brand name on them. That's the market they're going after, stuff where people don't really care about brand. And so they own a bunch of brands basically around that. And they sell through Amazon, Shopify, Walmart. I think they go direct to consumer as well online. But most of their sales come from Amazon. And the history is a little muddled. Apparently there is some drama, I guess, that went on with the founders. But I believe it was started in 2014. One of the co-founders was Yaniv Sarig. I might be saying that wrong, but he is also the current CEO. I actually really liked him. He seemed like a bright guy, but that's for another time. He grew up in Israel, and he said he was always fascinated with technology ever since he was young. But they started out really with the focus just on technology. They were like, what would an e-commerce company look like in the future? And they really focused on that AI to start. So trying to exploit opportunities with software insights. And And then they started to they had no experience with consumer goods, but they just went tech first and then started to buy those consumer goods brands. And they IPO'd, I believe, in 2019. But like I said, there's not a lot of history that's out there on them. I think the co-founders might have had a falling out because one of them apparently came back. Ian, you said that one of them is on Twitter, right?
Yeah, there's one on Twitter that you'll see around. I think his name is Asher DeLug, who owns, I was going to get into this a little bit later, but he owns about, I think it's 12% of the company or something like that. So still a fairly big stake, but doesn't seem to be involved in the day-to-day operations.
Yeah, not a highly covered name whatsoever. And that's, true, because the market cap for a long time was sub $100 million. But I'll get into the industry landscape competition. The Amazon third-party marketplace is growing really rapidly, and that's their main place where they sell. So third-party sellers are expected to grow at a 16% rate and hit over $500 billion by 2025. So a lot of volume is flowing through Amazon for the FBA stuff or whatever, third-party marketplace. There's undeniably a huge tailwind if these estimates are correct, especially over the next few years here. The competition is a little bit strange. So the largest would be something called Thrasio, which according to Mohawk has a $500 million in estimated sales, so a bit larger than Mohawk, and they've raised almost $1 billion. The popularity for a lot of PE companies, so private equity, to roll up these e-commerce brands has gotten, I don't know, they must have seen Mohawk's business model and thought, all right, there's a lot of white space here to just roll up a bunch of small e-commerce companies and do all the back office together. The other competitors, are traditional CPG brands. There's a ton of them out there, not a lot of individual competitors to name, or not a lot of there's not two or three. There's just, dozens and dozens across all of the different things they sell. And the landscape, right now there's 2.5 million active sellers on Amazon. A lot of them are individuals and smaller, but it just shows for Mohawk's acquisition strategy, there's probably a lot of rocks they can turn over.
Yeah, and they compete not only with other consumer goods that shoppers are looking for, but also there's other software optimization tools for Amazon sellers. So I believe they license their Amy content. And I think, Brady, I've seen you do some Amazon selling, right? Have you ever used any other softwares? That is one I've heard referenced. There's I
don't think they can hear what Brady's saying, but he said some software.
There's softwares that basically help you exploit the best opportunities. So they also compete on that front. I think Jungle Scout is one, and then Helium might be another one as well.
Yeah. But the software stuff's a really small part of the business, correct?
Yeah.
All right, Ian, what do you have for management?
Yep. So like Ryan mentioned, Yaniv Sarig is the CEO and founder. There's a really good YouTube interview with Sean Emery from Avery and Company that you can check out. That was kind of what first got me interested in Mohawk in the first place, was just listening to him talk. It's about 45 minutes long. And he seems like a really smart guy, thinking about the right things, seems to be a visionary and really kind of looking years into the future about what he wants to build Mohawk into. So like I said, I'd really recommend checking out that interview. He owns about 5% of the company, so a healthy stake. As I was just mentioning a second ago, there's also this guy named Asher DeLug, who you might have seen on Twitter. He tweets out stuff about this, about Mohawk sometimes, saying giving his own guidance estimates and saying stuff about what he thinks of the acquisitions and things like that. He, like I said, he doesn't seem to be currently involved with the company. He looks to be a former co-founder, and he owns 10 or 12% of the company, something around there. There's also, kind of just to go through the ownership structure, there's also a company called 9830 MacArthur, which sold e-commerce assets to Mohawk and is the largest shareholder, owning about 21% of the company. So this is kind of a good example of what Mohawk is doing a little bit with these acquisitions. As many of these acquisitions that they make, the acquired company, or generally it's like an individual who owns the company, actually wants stock in Mohawk rather than just cash. And so then the bigger the company is, then the larger portion of the common shares outstanding that they own going forward. And so there's quite a few like I said, Sean Emery and Avery and Co. looks like they actually own about almost 4% of the company, so they have a fairly healthy stake as well.
Nice.
And then
Sean. Nice. He's been like the first guy in on this name, so.
Yeah, he definitely deserves all the credit here. Basically, he's the one who first got it on my radar. So I saw some of his stuff on Twitter and got me interested. And then altogether, insiders own about 37% of Mohawk, which is a really, really big chunk. So definitely aligned with shareholder interest in that sense. I would expect that percentage to come down as they make more acquisitions and do some more dilution, but it's good to see for now.
Yeah, a lot of insider ownership. All right, I'll hit the valuation. Ticker is MWK. There's a Mohawk Industries, so don't get confused with that. It's the one that's MWK. There's one that looks exactly like it.
That's carpeting.
Yeah, so
carpeting.
Carpeting, yeah, it's a different company. You'll get confused, but it's MWK for those in the United States. I don't think it's probably not traded internationally yet. Enterprise value as of recording is about $661 million. So small cap. EBITDA sales is about 4, and they're unprofitable. While they're right around break even now over the last few quarters. No dividend, and share count has grown this year due to a follow-on offering. They IPO'd in 2019, and I think it was late 2019, so pretty close follow-on offering. But they're doing that to kind of raise money and go after this big market opportunity. You should expect, share dilution and, continuing of this acquisition strategy. They had about 21.8 million shares outstanding on September 30th and about 1.6 million stock options outstanding and about 2.36 million unvested restricted stock units. So a lot of dilution baked in there. And I'm putting this in there just because, again, you should expect the share count to go up over the next few years. It's not necessarily a bad thing. It's part of their strategy to retain talent and, go through their acquisitions and stuff like that. But it's just being part of a growth company. You have to price that into whatever model you're using for Mohawk Group.
Yeah. And a lot of those offerings are used like almost on a per need basis. So when they're getting ready to acquire a company, they'll just bake in some dilution to it, or they'll add stock to the acquisition costs. And so, I mean, as long as they're buying quality businesses and able to sort of develop them and scale them better, then I guess it's a good choice for them to sell that stock. But I'll get into the earnings. Last 12-month revenue was $170 million, up 57% year over year. They have about 44% gross margins. I think that was a little higher in the most recent quarter, but that's over last 12 months. They had negative $33 million in EBITDA for the trailing 12 months. They're pretty much break even on a cash flow basis. And in its most recent quarter, contribution margin increased from 8% to 19.1%. So their products kind of go through this 3-phase life cycle, and they highlight this on the 10K, but they have the launch phase. So this is the phase that I talked about early on, which is they identify the opportunity, they enter the market with a bunch of discounts, they do a bunch of marketing, and in this time, they expect net margins to approximately be about minus 35%. So they are basically selling this thing to hopefully reach scale and then not have to pay as much to get those sales done. And they want to be the top product for each of these categories. And then they hope every one of their products enters the next phase, which is the sustain phase. And they target a 10% net margin for this phase. That's what they want every product to go to. That's sort of the end. That's the paradise. They hope they reach the sustain phase. And they peel back the marketing costs on those. And then the third one is the milk phase. That's what they call it. And this is when the product doesn't enter the sustain phase. So if customer satisfaction is low, ratings are bad, they will just liquidate it and sell the remaining inventory. They, as of their last report, they haven't had any products hit that phase yet. So they've been perfect so far, but they did just make a bunch of acquisitions. So they launched 8 new products in the third quarter versus 3 last year. But since the third quarter, I think they made acquisitions of 43 new products to the portfolio. So keep in mind, the whole third quarter, they added 8 new products. And then since then, they've added 43 new products. So and that was done through acquisitions, I think, of like almost 6 different brands. And they're getting these brands at a pretty low multiple, which I'll talk about later. But yeah, does that kind of cover the earnings? Their forward guidance is probably the most important part because they're going to have a lot of inorganic growth from these acquisitions. Sales was like way up, at least their guidance was.
Yes, they're going to be aggressive, or they are being aggressive with those acquisitions and trying to grow the portfolio. I think that's That's clear. Ian, do you want to hit balance sheet before we wrap up the first half?
Yep. And before I dive into the balance sheet, I just want to touch briefly on what Ryan was saying there about the different phases, because I think he laid that out really well. And it dawned on me that it's a little bit like, you can't call this recurring revenue. It's different customers that are buying the products. But in a sense, it kind of has some similarities to some of these recurring revenue models we see, because they spend a bunch of money up front to get the customers in a recurring revenue model, right? You spend a bunch of money, you get the customers, and then they just keep paying you quarter after quarter after quarter. With Mohawk's model, they pay a bunch of money up front to get the reviews, and the reviews attract customers at no cost to the company at that point. And so they kind of spend the money up front to get the reviews, which then creates a somewhat similar stream to recurring revenue in a sense. So like I said, it's kind of an interesting, it just dawned on me as you were talking about that, Ryan, but I think it's an interesting model.
And the CEO mentioned in that interview with Sean Emery, he's like, a lot of the customers now, they're making purchasing decisions based off data that's readily available. So they're not necessarily looking up a brand name, but they're looking up the item and then just scrolling through reviews, pictures, and stuff like that. So they're really trying to optimize for the third-party e-commerce platforms. Yep.
And I think what they say is if they can get above a 4.3 on the ratings, that really gets them to that sustain phase. If they can get 4.3 on ratings, then they're in good shape. So anyways,
that's what I care about, the good rating on Amazon.
It totally makes sense. Yeah. I can go ahead and dive into the balance sheet. So they've got, and this is, you'll want to check on this once the next quarter comes out too, because like Ryan mentioned, they've been pretty active on some of these acquisitions and stuff. But as of the last quarter, they had $37 million in cash, about $26 million in debt, which was kind of expensive debt. It was about a 6% rate on a term loan they have that was around, I think 14 million left on that. And then 10% on the revolver, which was the rest of it. So there may be an opportunity to get that refinanced.
Hopefully
at a lower rate. Yeah. You would hope in this environment, but
they paid down that revolver early, if I'm not mistaken.
Some of it, I think some of it. Yeah. They had 25 million out on the revolver, I believe. They paid like half of it back, if I'm correct.
Okay. Yes, I believe so. Like I said, you're going to want to check the most updated. They've been pretty active in the last 3 months. And so you're going to want to check the next quarterly report to see how it all shook out. But they have been paying down some of their debt. Like I said, it could change a lot because of these acquisitions. So one other piece I'll point out is their inventory ratio, inventory turnover ratio is up to 3.8 times. Which means basically for every that they're selling through all their inventory 4 times in a year, 3.8 times in a year, which is up from 1.9 times in 2019. They actually have less inventory on the balance sheet now than they did back in 2019 when they weren't doing nearly as many sales. And so that's pretty exciting, just that they can get more efficient like that. It helps improve their operating margin, the net margin. So something to keep watching. If they can really bump that inventory turnover ratio even higher, that would be pretty exciting, but definitely moving in the right direction there. So generally happy with the balance sheet. Love to see a little bit of a debt refinance, but looking good.
Yeah, the inventory ratio will be interesting to watch to see if they can increase that or sustain this one over time. That can really help their cash flow. But we're going to get to the ad break here, and then we're going to move to the second half of the show, talk more analysis on Mohawk Group. All right, welcome back. Next up is competitive advantages for Mohawk Group. So Ian, kick things off. What do you have?
Yep. So I think the major competitive advantage as I see it is their expertise. They've done this for long enough that they understand how to roll up brands and really make them as profitable as can be. They get them at attractive multiples, fast integrations. They say that it takes them less than 48 hours to get the new brands that they buy integrated into their systems and producing through Mohawk, and also enhanced logistics networks and even manufacturing relationships. Many of their products, you'll notice, are kind of big, bulky things like dehumidifiers. There's like a space heater thing. There's some stuff like that that's traditionally kind of harder for people to manufacture, and they've built relationships that really they can manufacture those with high quality and at a reasonable price. So it's really, I think their expertise just in this area is really a competitive advantage. And they also don't really need to take on additional staff when they make these acquisitions. They're able to just bring the products over.
Right. They just basically outsource a lot of the logistics to Amazon, who's the best at that. Seems like that makes sense.
Right.
And it keeps them asset light. But Ryan, what do you have for competitive advantages?
So I guess their acquisition targets are like consumer goods businesses that are selling stuff through e-commerce strategies, whether it's Amazon or Shopify, stuff like that. And that's, that can make some good money for individuals or small businesses, but it's really, really hard to scale those. And so as they reach sort of a threshold, then they look for, all right, can I sell this? Can I sell my business at a premium? And their premiums are really cheap. Mohawk Group is getting most of these companies for 3 or 4 times EBITDA multiples, which is super, super cheap. 3 or 4 times sales multiples in this world seems cheap. So
Mohawk trades at 4 times sales, so they're basically acquiring them, and the valuation technically has just kind of inflates because they're a part of Mohawk then.
Right. And so, for example, they just bought Healing Solutions LLC. And so this just sells essential oils. And it had the Healing Solutions had $12.7 million in operating income for the last 12 months. Mohawk Group bought them at 3.8 times their operating income. And I believe their operating margin was somewhere around 15 or 20%. So they can buy these businesses for really, really cheap because they're so niche and not that many. They have the ability to really scale these niche operations. Most acquirers don't want to buy this company because then they have to do the work to make it better. Mohawk thrives on that. And that's it feels like a big advantage for them. Yeah, Ian.
Yeah. And I was just going to say one thing that was interesting. They did a call about the transaction a few days ago, and I'd really recommend looking at it. It was about 40 minutes or something. But one of the things that the CEO mentioned on there is, hey, these seem like really low multiples to us, and they are. And then they, get incorporated into us and immediately get a re-rating. But to the people that are buying them from us, they seem like higher multiples because those people are taking the operating income they're getting, and then they're having to pay expenses out of it. And so they're really thinking about what their take home pay is as the owner. Right. And so they're looking at it and going, if I can get, and sometimes it's only a quarter of what operating income is. So if I can get 4 times the operating income, that's 16 times or 10 times, somewhere in that range, my take home pay, which really makes sense for a lot of these, because it's a lot of small companies, right? It's small kind of owner operated companies. And so they look at it and they say, I can cash out for 10 to 15 times my take home pay. That works for me, but it works great for Mohawk to immediately buy it at 3 to 4 times EBITDA and get it valued at 4 times sales.
Right. Cause they X out all that overhead.
It's a Shark Tank conglomerate. These are like the Shark Tank businesses, all those businesses that you see being pitched on Shark Tank. Mohawk's just buying them.
Yeah, hopefully it's not actually those really bad ones that are on Shark Tank.
Yeah.
All right, I'll have mine. Theoretically, the machine learning stuff it can help identify products, and there should be an economies of scale there where they have the data advantage, or however you want to call that. I'd be interested to see if they could do some work where, like, Stitch Fix publishes how they do all their stuff for identifying, products for clients and how it all works, because I'm a little skeptical that it goes beyond, like, all right, this product category doesn't have anything above 4 stars. Let's go do something there. That doesn't seem like something that machine learning you really need it for. Or maybe, the strategy's working, right? But they might be overhyping it there. Now with marketing, automating marketing, logistics stuff, getting that, with the data advantage could work. But again, I'm a little skeptical on parts of it, but it seems like the machine learning stuff could get them some sort of competitive advantage or moat around the business.
Yeah, theoretically, that's supposed to be their big competitive advantage, right?
Yeah, it doesn't make sense to me why they're outsourcing Amy, right?
That's always kind of confused me a little bit too. Like, if it's that valuable of a tool, yeah. And I assume maybe what it is that it's just there's enough supply out there. How many third-party sellers did you say there were?
2.5 million.
Yeah, 2.5 million. There's enough supply out there, and there's enough places to do good deals that they can't take them all on. And so, maybe they outsource the software a little bit, but.
And I think I guess I could be wrong on this, but I think they're only licensing sort of a limited part of AME.
Okay.
Because it is called they label it as managed SaaS. And this is my future growth opportunity because I think being a seller on Amazon, that could make some income for people, but it's really hard to make a ton of money being a seller on Amazon. And so hopefully Amy can help a lot of people do that. Obviously the TAM there, the addressable market, like Brett just said, 2.5 million sellers. That's a lot of people. It's a lot of potential customers. And for reference, the more sellers that Amazon has on the platform, the higher customer acquisition costs grow. And so the more that you can optimize your strategies, marketing strategies, logistics, stuff like that, the better you can be as a seller. And Amy really lets people do that. And I hope that it is sort of a limited offering. I hope they're not giving them like the market identifier part, because there's obviously the logistics part of when you're actually selling the product. They're still using Amy, but then there's the opportunity identifier, which gives them which markets to go into. If they're giving them that part, that's a little concerning for me because you're just inviting competition, whereas instead of just helping other people.
Yeah, I mean, I don't know. That part of the business doesn't. I don't know. I'm not an expert on it all, but that part of the business doesn't make that much sense to me. If you have the, Mohawk group on its own too.
Okay. All right. Ian, what do you have?
Yep. So I've got kind of the obvious one for future growth opportunities. I'm looking at acquisitions. They just make too much sense right now. Capital's cheap. You can go grab a big chunk of the market while you can, roll up as many of these little businesses, bring them in, get the multiple re-rate. They say the space is getting more heated. And I think, Brett, you may have mentioned this too, just about the PE firms that are diving into this space.
Yeah.
Thrasio, it's
like
getting more heated. Yeah. And it's getting more heated. People are looking at this going, hey, we can the economics on this really work, which is a good sign in one sense, but it also is, these multiples that they're having to pay may start going up on some of these businesses. One other note on acquisitions, the essential oils acquisition that Ryan mentioned was their first move into consumables. Most of their products have been durables. And so, things that people buy the humidifier, space heater, things like exercise equipment, things like that. But now with the essential oils, there's actually the potential for some repeat customers. And I think on the call, they said that they're thinking about moving into more consumables. They'll see how this goes, but they see that as another growth avenue.
Okay. I'll hit mine then. It's another simple one, but it's international. Right now, they do none of their stuff outside of North America. It's, I think, 98 or 99% of the revenue was in North America. The model scales. Everyone needs these type of products, or maybe everyone likes to, every country has people that use products like this. So it's simple, but it seems like there's a lot of room to run there. Amazon is pretty global. So once that scales out to there, or they could go to some of the local names like, Mercado Libre in Latin America. You got, what is it in India? It's called Flipkart in India. China, you obviously have Alibaba and JD.com, and maybe Tencent. I don't know. Tencent does everything. But then another thing would be, like Ian mentioned, the long-term shareholders. I mean, I think they would love an equity raise at these prices, or just using a ton of stock to buy companies, because if you're trading at 4 times sales or whatever we're at right now, the stock is up 5x over the last few months. Yeah, you would love to see management take advantage of that.
They're also, they're not generating, maybe they did last quarter, but they're not really generating cash flow. So they need to find that cash somewhere.
Why don't, they're paying 10% on their debt. Well, let's do a raise and just X that out, right? Come on, the market, the market wants to do it. Yeah. All right. What about highlights and lowlights, Ian? What do you got?
Yep. So my highlights, simple model. You find a product or a market inefficiency. You go build a product that's a little better than the other one, get a 4.3 star rating. It turns into 10 to 20% contribution margin, and they have an 80% success rate with that. Those economics work. And if they can continue to do that, whether it's through acquisitions or through launching their own products, that's a model for success. I'm also encouraged, like I said, by being more efficient with inventory, and they're being aggressive right now. They've made a lot of acquisitions in the last few months, and I like to see that they're really trying to take the bull by the horns, I guess, and just really take advantage of kind of the momentum they have and really try and get as big as they can right now. A couple little lowlights, we've mentioned it already, but the higher cost debt, dilution too. Like share count has doubled since 2018. And I don't think this is like a red flag or anything. It's a reality of this company, is like Brett said earlier. You have to bake this into your models if you're looking at it, that dilution will occur both from, employee options, but also majority of that's going to come from these acquisitions that they make, which if the one that they made recently is any indication, I think the stock jumped like 20-25% on the news of the acquisition. So the market likes these acquisitions. The company becomes more valuable with them, but there is going to be some dilution. And then the last low light I have is just some competition. The multiples they're getting on some of these businesses right now may not still be there.
Yeah,
in the next few months. It may rise, and it may be more like 6 or 7 times, but we'll see.
All right, Ryan, what do you got?
I like Yaniv Sarik. I thought that interview with him and Sean was really, really good. It does feel like a really interesting. It's a simple business. It's super it's analyzable. I guess it's easy enough to understand. It's not too complex. My only problems are it kind of feels like you're throwing money at an algorithm without knowing what's all behind it. The AI is only as smart as the people that built it. It also, as far as the business goes, it seems very unorganized. And so there was a lot of, there are some interviews with ex-employees, and some of the employees only were there for like a year and a half. So it looked like there was some employee turnover, but from what they said, it seemed very unorganized. Yaniv Sarik seemed like everyone had high praise for him, but organizationally, it seems like they're a little distraught right now. Maybe
need a COO, or a good one.
Yeah, it might just be they're young and they're moving fast, and maybe that's the life of a startup. But it feels the business itself operationally needs to be sort of streamlined.
Yeah, and I think and I agree with the low light you have there about the algorithm thing. I kind of have a concern with that as well, because I think it's maybe there's more to it than meets the eye, but I think it's copyable, right? I mean, you kind of you can kind of think. I mean, as long as you can code it out. Or
people said, I read some interviews about this, and no, it is doable if you figure it out, but apparently it took a lot of trial and error and time to get to that. So if you had sort of the rules and principles to code out, anyone can build it, but to find those rules and principles, it takes a lot of trial and error and sort of sweat equity, I guess is.
Okay. So it's copyable. It might take a year at least or longer.
Yeah.
Okay. All right. I'll hit my highlights. We're seeing a lot of gross margin expansion right now, which I think is strong. You can apply the business model to any product on Amazon and to any country Amazon sells them. They're just going to ride that Amazon tailwind, which has just been impressive, especially for that third-party marketplace. One lowlight that I had some of the other ones that are similar to you guys, but one lowlight that you guys didn't talk about was the PPE. So PPE, not property and equipment, but the medical sales. So last year they had, I believe you'd probably say it's an artificial bump. So they said we saw an increase in wholesale revenue last quarter of $9.8 million versus the prior year, primarily from the sale of PPE during the current period. So the last 3 months, a lot of their growth was from this, healthcare equipment and stuff like that for medical workers. I'm not sure that can repeat, because that basically came out of nowhere. And it was a great idea to do it during the pandemic. But is that an artificial bump? I don't know. Revenue growth might not be as impressive when you take that into account.
I do think it's sort of minute in comparison to their actual sales, especially the sales that they've forecasted for this next year.
Are you sure though? Because 9.8 million of what?
I think they forecasted for 300 to 500 million.
I know that was per quarter. 9.8 million of the revenue they had last quarter. 9.8 of the 58 million in revenue they had last quarter was from PPE. That's material to me.
Yeah, but I mean, going forward, I think their guidance probably takes that into account, I would assume, right? And their guidance was still pretty strong.
Yeah.
Right.
Yeah.
It was still
yeah,
it was still healthy guidance for sure.
Yeah,
And
definitely.
they also have said they've gotten some pushback that is this guidance a little bit light. And they've kind of said, yeah, kind of tongue in cheek, like, yeah, it's a little, we like to be conservative or something. Yeah.
Okay.
Yeah.
More or less interested. Ian, you want to go first?
I think we know your question because you do.
Yeah, I do own it. I was just telling you guys it's up to, I think, my third biggest position now. And I like the stock. I think like we've talked about, I think the CEO is really smart. They seem to be moving in the right direction, and it seems like it's just a really solid model that would be hard to screw up at this point unless they really overextended themselves. They seem like they're just kind of clicking on all cylinders, and I'm looking forward to seeing what happens over this next year.
Okay, Ryan.
Yeah, it seems like they were sort of like move fast and break things model over the last 5 years, but I think they've figured it out. And they like Ian said, they're moving a lot better now, and they're more consistent and sort of firing on all cylinders, if you will. I do like the business. I don't typically like stocks that move 40% in a day. If it
Unless
moves,
you own them.
Yeah, but I don't like. Maybe I'm slow moving, but I don't like sporadic movements because then you feel like you have to capitalize on them, and it sometimes becomes harder to own. Like I want something that I can own and just look away. Something that moves that fast sometimes concerns me, but that's what you get with small caps. And yeah, the business, all in all, I do like it a lot. What about you?
Yeah, I mean the business. I like the business. Definitely more interested. If you're potentially a new investor, this obviously isn't a recommendation to buy or sell anything, but don't anchor to what the price was this summer. The valuation at an EV to sales of 4, which should be probably go down to about 3 or something next year. It doesn't seem crazy. Now they guide for long-term adjusted EBITDA margins of about 13 to 50%, which throw those out the window, but that probably indicates that free cash flow margins will be about 8 to 10%. So if you think that free cash flow margins at scale will be about 10%, you're probably getting it at 40 times terminal free cash flow right now.
Yeah.
Add in some share dilution, you might be at about 50 to 60 times. So you're pricing in, if you think at maturity, it'll trade at like 20 to 25 times free cash flow. You're pricing in a few years of growth, but it's not a crazy
realistic right now.
Yeah, it seems pretty fair. I mean, the summer is obviously a lot better. Hindsight's 20/20, but
I don't think the valuation's too crazy. But
it's definitely higher than it will be unless they can get free cash flow margins to higher than whatever their adjusted EBITDA margins. It is higher than what their terminal multiple will be, but it's not that much higher. It's not like they're trading at 200 times.
Yeah, agreed.
All right, that's going to do it for this episode. No. I know I'm going to say my pick for next week. It's my turn. We're doing Avalara. You ever heard of that one? It's a software company for tax automation. I know Brady's been doing taxes here, so we might actually need some anecdotal evidence for that. But
was the CEO the guy who was just on Invest Like the Best?
I don't know, but if he was, we will make sure to listen. I don't know. He might have. But either way, interesting company. I don't know much about it right now, but I like the business model. Seems like something that everyone needs. So, yeah.
All right. Hold on. I'm pulling it up right now.
Okay. Ian, you ever heard of Avalara?
I've heard of it. I haven't ever looked deep into it, so excited to take a look at it this week.
Oh, okay. No, it was Asana.
That was Dustin Moskovitz, actually, the forgotten Facebook founder. Never forget.
Shame. All right, Avalara.
Sounds good. Well, maybe you guys can get him on the podcast.
Yeah, we'll definitely be able to. We'll get the CEO of a $10 billion company on. No problem. That'll be very easy. But that's going to do it for this episode, guys. As always, make sure you use our promo code CCM at checkout to get $10 off your first month at 7 Investing. Remember, Ryan and I are partners at Arch Capital. We run an investment fund called Arch Capital, and clients may hold securities discussed on this podcast. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Thank you all for listening. We'll see you on our next episode.